The world today is facing a level of debt has reached over $300 trillion, an amount so large that it is difficult for the human mind to truly comprehend. This debt includes all forms of government debt, corporate debt, household debt, includes all forms of government debt, corporate debt, and financial obligations across every nation on the planet. When we look at the countries with the highest debt, Japan stands at the top with debt exceeding 200% of its annual economic output, known as GDP. That is more than twice the size of the entire economy each year, a number that sounds alarming, yet the country has maintained stability for decades, with debt approaching $33 trillion and rising steadily, followed by China, which has seen a meteoric rise in debt levels over the past 2 decades. The growth of stimulus packages marked a collapse to prevent economic collapse during the COVID-19 pandemic, where governments unleashed trillions of dollars in fiscal support to keep businesses afloat and people employed while lockdowns and restrictions paralyzed normal economic activity. During these periods, the world borrowed not just out of necessity, but also out of urgency, creating a debt-fueled cycle that continues to this day. But why did it grow so fast, and why has the pace of borrowing accelerated in modern times? One reason is that low interest rates have made borrowing cheap, encouraging governments, corporations, and even individuals to take on more debt. The cost of borrowing is minimal compared to the potential return on investment or the political need to provide social support, leading to a calamity. Ben presents a possible and real estate case when examining the dangers and opportunities of high debt. The country experienced what is known as the lost 3 decades, beginning in the early 1990s. After a massive asset bubble in real estate and stocks collapsed, Japan found itself with enormous debt relative to GDP and stagnant economic growth. For 30 years, Japan struggled to grow its economy, relying heavily on government spending and central bank interventions to prevent deflation and economic collapse. Despite this, Japan has maintained social stability and has not experienced a financial meltdown, which teaches us that debt, while alarming on paper, can be managed under the right conditions and with disciplined monetary policy. Globally, the rise of debt has significant obedient more to maintain their security, both in terms of defense and domestic instability. So, who actually holds all this debt? Sovereign debt is often held by a combination of domestic institutions, foreign governments, and private investors. In some cases, countries owe money to their own citizens through bonds, while in other cases, debt is owed to foreign nations, multinational organizations. This complex web of obligations creates both risk and interdependence, meaning that the collapse of one major economy can have ripple effects across the entire financial system. It is important to understand that while debt can be scary, it is not inherently bad. Borrowing allows for investment, innovation, and crisis management and long-term planning. In recent times, other assets, such as government bonds from stable economies, certain commodities, and even real estate in strong markets, are often considered safer options, though each carries its own risks and considerations. As we think about the future, the question arises, how will this era of unprecedented global debt eventually end? Some economists predict a period of restructuring where debt levels are adjusted through inflation, renegotiation, or even partial default. Others envision a gradual unwinding, with careful fiscal and monetary policy reducing debt over decades. What is certain is that debt is not a problem that can be solved overnight. It is a long-term challenge that requires global cooperation, disciplined economic planning, and an understanding of the risks and benefits of borrowing. Action is the world navigates new challenges, from climate change to technological disruption to geopolitical conflict. The key lesson is that debt is not merely a number on a balance sheet. It is a reflection of choices, priorities, and human ingenuity. Understanding who owes what, why the borrowing occurred, and how it is managed is essential for anyone seeking to grasp the complexities of the modern global economy. In the end, the story of global debt is a story about the balance between risk and opportunity, caution and ambition, and the ongoing effort to create stability in a world that is constantly changing. When we examine the astonishing speed at which global debt has grown over the past few decades, we begin to see a complex web of causes, each interacting with the other to create a perfect. Central banks, de facto, have kept borrowing costs exceptionally low for decades. Low for decades behind borrowing is means without immediately feeling the burden of repayment. The incentives are clear. When the cost of borrowing is minimal, it becomes much easier to finance infrastructure projects, social programs, corporate expansion, and even consumption. As a result, debt naturally expands, almost as if the system itself is encouraging more borrowing. Another key factor behind the rapid growth of debt is the increasing complexity and globalization of financial markets. In the past, debt was often a local phenomenon, limited to a country's own banks and citizens. Today, money flows across borders instantly, and capital seeks the highest return regardless regardless. Elsewhere, fasterization had 19 pandemic provided essential debt levels. We're faced with situation challenge, how to maintain while entire challenge, how to maintain economic stability while entire industry shut down and unemployment spiked. Stimulus packages, unemployment benefits, corporate bailouts, and public health spending added trillions of dollars to already high debt levels. What is remarkable is how quickly these measures were implemented. In less than 2 years, global debt increased by tens of trillions of dollars. It was a historic acceleration, born out of necessity, but it also highlighted the vulnerability of the global financial system to sudden shocks. Governments were forced to borrow not just for long-term development, but for short-term. This expectation has created an environment where borrow is sanctions or another hidden nations or another hidden debt growth. Sanctions are another hidden accelerator of debt. Trade wars, sanctions, and military conflicts all prompt governments to spend more to protect national interests. For example, when trade wars disrupt supply chains and domestic industries, countries often respond by borrowing to stimulate their economies or protect strategic sectors. The war in Ukraine is another modern example. With global energy and food markets disrupted, governments have borrowed heavily to subsidize energy, stabilize domestic markets, and support military spending. Debt grows not only because of internal economic decisions, but also because the external environment. The psychological element perceives security in borrowing, a space security in Bahams, behind closed perfils. Behind closed change has been underestimated as a driving force behind global debt growth. Technological change has had a paradoxical effect on debt. On one hand, technological innovation can increase productivity, encourage productivity, and pressures to spend, invest, and compete globally. Digitalization, automation, and the rise of artificial intelligence demand investment, which often comes through borrowing. The tech boom has led to massive corporate debt, particularly in sectors like e-commerce, software development, and biotechnology. Companies borrow aggressively to innovate and capture corporate balance between the delicate balance between inflation to managing rapid debt growth. Corporate portion financial on equity financing to borrowing as a primary source of capital. Debt is often cheaper than equity financing to borrowing as a primary source of capital. Debt is often cheaper than issuing new shares, and low interest rates make this strategy attractive. However, this strategy amplifies financial leverage. While it can boost return downturns, making corporate debt a significant contributor to overall global debt growth. Similarly, households have taken advantage of historically low mortgage rates to borrow larger sums, often stretching household budgets to their limits. This debt has occurred during oppression, instability. There has occurred during a possibility global economic collapses on the scale of the Great Depression, yet debt has surged to levels previously thought impossible, suggesting that the system itself has evolved to tolerate and even encourage ever higher borrowing. The lessons of this rapid debt growth are profound. Debt can be a powerful tool enabling governments, corporations, and individuals to invest in the future and weather crises. Yet the speed and scale of debt accumulation also carry significant risks, increase vulnerability to interest rate changes, and create interdependencies that can amplify shocks. Understanding the mechanisms behind debt growth is essential for policymakers and careful expectations will say careful planning, disciplined policy, and an understanding that debt, while powerful, is a double-edged sword. How we navigate this complex landscape will shape the economic destiny of nations and the financial well-being of billions of people around the world. Japan's experience over the past 3 decades offers a cautionary tale and a source of insight into the challenges of managing high debt and prolonged economic stagnation. The story begins in the late 1980s when Japan was riding a wave of unprecedented economic growth. The country had become the world's second largest economy, a technological powerhouse, and a global financial booming, creating immense wealth for corporations. Decades government borrowed heavily to stimulate the economic wisdom suggests infrastructure spending and social maintain most projects were financed largely through debt. Japan's debt to GDP ratio soared to over 200%, making it one of the highest in the world. Conventional economic wisdom suggests that such high levels of debt would lead to crisis, yet Japan maintained financial stability subdued, and the government continued to service its debt without defaulting. This demonstrates that high debt, while risky, can be managed under certain conditions, particularly when the debt is held domestically and the country has control over its monetary policy. The lessons from Japan's monetary policy cannot be overstated. Second, Japan's experience for structural economic problems. Second, Japan's experience highlights the dangers of asset bubbles. The rapid rise in property and stock values during the 1980s created a sense of wealth that was largely illusory. When the bubble burst, it left the economy economy saddled with non-performing loans and deflationary pressures. Businesses became risk-averse, consumers held dramatically. This prolonged stagnation illustrates the challenges of recovering from a financial shock, especially in a highly leveraged economy. It also underscores the importance of careful regulatory oversight and prudent lending practices to prevent similar crises in other countries. Third, demographic factors played a fourth. The stagnus, pagnus, gagnus, strophigness, vagueness, stagnant, goss, stability, highness, strophic, nanmain, stagnus. Businesses is stagnus, strophagnus, and a strong industrial base. Businesses adapted by focusing on quality, technology, and export competitiveness, even in the face of domestic economic challenges. Fourth, while massive prudently and the government maintained a disciplined economic challenges, while massive public spending helped prevent social unrest and financial collapse, showing that managing debt is not just a matter of numbers, it is also about institutions, culture, and resilience. Far stabilizations, cultural force stimulus, while massive plus stimulus, while massive bent deeper recession. Foreign assets significant sufficient investments is some of the sufficient investment managements is the subfront and shaped global perceptions of risk and security. This underscores the interconnected nature of modern economies. What happens in one high debt nation can have ripple effects across global financial markets. Another important lesson from Japan's experience is the potential role of deflation in debt management. For decades, Japan faced persistent deflation, where prices gradually fell. While deflation can be harmful because it discourages spending and investment, it also increases the real value of fiscal strategies, however, allowed it to manage this deflationary pressure without triggering a broader financial crisis. This mindset also slowed economic revitalizations. It is a reminder that the human response to decisions are market forces. Despite these challenges, Japan has remained a global economic leader, demonstrating that high debt and slow growth are not synonymous with collapse. Innovation continues in technology, manufacturing, and finance. The country remains a model for infrastructure development, education, and social cohesion. Japan's story emphasizes that managing debt successfully is not just about reducing numbers on a balance sheet, but about maintaining stability, fostering innovation, and adapting to changing circumstances. It is a story of resilience, careful planning, and In summary, Japan's lost 3 decades illustrate the decanages associated with high debt academics, a social and monetary policy, and institutional resilience, and the limitations of fiscal stimulus. They show that debt management is not simply a technical exercise, but a complex interplay of economics, policy, society, and human psychology. Understanding Japan's experience in enormous debt, it is possible to maintain stability, foster resilience, and create a foundation today as nations around the world face unprecedented levels of debt, geopolitical uncertainty, and economic disruption, and manage social obligations. Understanding Japan's collapse and sustain social and economic well-being even in the most challenging circumstances. The next topic in sequence could be trade wars, Ukraine, and global conflict, the debt and economic impact, which ties Japan's lessons to contemporary geopolitical and economic events.